What's up, everybody? Welcome to another edition of Zacks Live Trader. Here with you, as always, I am the bearded boy wonder, Dave Bartosiak, and today, my friends, already active in the chat. I was trying to help David Newman out with this whole Haynes Celestial situation. So that's kind of why I didn't want to get into a live earnings thing with them, because it had been so long since they reported, and it's really kind of a wild card event out there, so I just didn't want to get into it, right? But what we are getting into here is Palo Alto Networks, ticker PANW. So remember, there's a little bit of a delay from the time where I talk and you guys hear it. It's about 30 seconds, I think. 30 seconds, maybe 60 seconds. I forget how long it is. I think it's 30. But I do have the live chat window up, so when you hear me talking some random nonsense, it's likely because I saw it in the chat and I was responding to it. So we got a bunch of people here, rip-roaring and ready to rock. So why don't we go ahead and kick off this shortened holiday week. I hope everybody had as much fun as I did. I was just like 2.5 feet of water in a floaty on the ocean, just chilling. I was there for like 3 hours. It was great. Good stuff. I'm a little roasted today. Not too bad, though. Plan on going back out there. Not today, though. Maybe this weekend. We'll see. All right, so what's the scenario here? Palo Alto Networks. First, let's look at the price consensus and EPS surprise chart like we always do. The black line corresponds to the right y-axis, which is price. And the little red arrows are earnings misses. I wish there was a green arrow here, because that's an earnings beat, but they haven't had one. The multicolored lines represent the evolution of our Zacks consensus estimates over time, and you can see high bars, and then they go ahead and dip. High bars and dip, and high bars and dip, right? Dr. Paul, the cough, I still get the morning stuff falling back in there, man. I gotta figure something out. We'll talk offline. Anyway, so these multicolored lines, Zacks consensus estimates, you'll see they always start high, and then they trickle down lower throughout the course of the year. And this is almost the exact opposite of what you want to see, because even at their height, they're progressively lower year in and year out, okay? So what do we have on our hands, folks? We have a company that's not so worried about this EPS number. And if you notice, this EPS number is negative. Negative. So let this marinate just for a hot second here while we're on this page, right? So here we've got a $115 stock. It's come under pressure since the last bad earnings report. They haven't beat on earnings since 2012. And they haven't earned money since, I don't know, ever. But that means we're going to have to be looking at the revenues on this one. Now, unfortunately, our price consensus and EPS surprise chart doesn't really care about revenues. We're not going to see any of that. So I gotta go to my G14 classified research and see if I can find something there. But I still don't know how a company just cares so little that they continue to allow Wall Street to push that number too high so they can't get anywhere close to making that money, right? Or even come close. Why can't you manage the expectations a little better? Why are you constantly setting us up for failure on each and every one of these earnings reports? That's a little bit of a head scratcher to me. And in 2014 and 2015, it didn't matter so much because you still actually had growth, right? So here was the promise of growth. Like, hey, it's coming next year, guys. Don't worry about it. And I think that the market bid the stock up on that. So here in late 2015, we started to say, wait a minute. You're not even going to give us EPS next year. And now all of these numbers are coming down. And we've seen these sort of expectations bottom out a little bit, but sliver of hope. They have increased just a little bit here in terms of the EPS estimates, which won't matter because they won't make it. They'll disappoint, right? Because that's what they do. But just an interesting flow to this chart. So patience ran out in late 2015, and the stock kind of held up, but then this last report really took it down, and we can see that on the technical chart here, and here's the shelf. Whoops! And heading into that report, of course, you have whoops from the previous quarter, right? Bottoming out. Then they rally up. They fill the gap. Gaps get filled. And then another report. So into filling this gap, you had all sorts of good stuff going on. And this is coming into last quarter. Lots of positivity heading into that quarter. You got money flows that were positive. So you had a lot of institutional money getting in there. And then you have these the commodity channel index here. Positive before turning down negative after the report. But that report, this thing went from $1.50 to under 120 in a heartbeat. And now this gaping hole that's left tried to begin to fill in that gap, and the market rejected it. It was kind of a one-day event where it ticked up and then was rejected. So now what do you have? Now you have a stock that's down in 115. And if you scroll out a little bit, you can see we've been down here before. February low, and then again June of 2016, and then here we are. So that's kind of where the band of volume is right here, this 115, and I think that's where they're going to peg this thing heading into earnings tomorrow. So when you have these huge gaps, it definitely throws off your money flow, okay? So you got to kind of ignore this whole thing because it's just, but it doesn't matter. We've got the huge gap down, and that's what we're really playing off. So I suppose what we can do is draw fibs down from that level, but that's just to the upside. It doesn't take a rocket scientist to figure out where the upside limitations are. So you got the Monday, May 15th high of 122. Then you have sort of this low of 123.50 that you put in late December. So these are kind of the areas you got to look for, okay? All right, so let's get back to our Zacksiness. And surprisingly to me, and PANW also, who was putting this together earlier for me, we've got Zacks ranked number 2 buy. Even though all these numbers look so terrible. So we're going to have to, I'll explain this a little further. So they're going to report after the market closes tomorrow. So you got the rest of the trading day today and all of tomorrow to decide what it is you want to do. Yeah, earnings has been negative, so you get a good old NA for your PE. So, top 28% of our Zacks industry rank here. And if you look at the sales, so revenue side, this is really what we're concerned with. Year-over-year revenue growth, solid revenue growth, okay? For some reason, this quarter's dipping a little bit to 19.36. Next quarter looks like 21 and change. Current year number, 24.78. Next year, 22.82. And that sounds fantastic. However, look at the actual revenue here that I'm going to pull up. And you can see here, huge growth, 2015, 2014, or 2013, 14, 15 rather. And then last year, 48. There's a big difference between getting 48.5% revenue growth and 24.8% revenue growth. Especially when you're talking about a stock that keeps on disappointing on the EPS side of things. So, yes, 24% revenue growth is great. But when compared to 48.5%, or here on, next year is going to be 23.29, which is fine. I mean, these are still solid numbers. Don't get me wrong, but is 24% revenue growth enough for a company to be able to say, yeah, we don't care about EPS at all, we'll just keep losing money? Like, I don't know. I think, and I don't even have to be here a hardline speculator on this. All I have to do is see what the market's already done. And the market has told us that, yes, in fact, they are beginning to lose their patience because last time they got absolutely slaughtered when it came to earnings. Let's look at some historical sort of Zacks rankiness here while I've got this up. And this is, again, super choppy because we're basing this on EPS estimates, right? So, and if the stock is kind of ignoring EPS, unfortunately, we have to take our Zacks rankiness with a grain of salt when it comes to this one. I'm just going to draw a bunch of X's on the chart because I'm pent up. But, so that's the thing. It's like we got to, the Zacks rank with Palo Alto Networks, I think you got to throw it out the window. Some stocks are like that. Amazon used to be like that. It's rare that this does come up, but I think in this case, we shouldn't worry so much about it. I'm going to go back to the our detailed estimates page, and we'll bounce back a little bit. But so EPS, on paper, this all looks fantastic, but so I lost 86 cents last year. I'm only going to lose 41 cents this year. I guess that's 50% growth. And you look at the current year numbers, still slated to lose $1.25, and next year you're still going to lose 86 cents. Now, why is it in the good graces of the Zacks rank? Is that over the course of the last month, you do have one analyst that has increased their earnings expectations for next quarter and the current year. But that movement in analysts' rankings, or his estimates rather, their estimates, just 1 penny. So it's only changed our Zacks consensus estimate for next quarter by 1 penny. And so that's had an effect on the current year of just 3 pennies. So they're going to lose 3 pennies less, right? So in terms of the Zacks rank, I don't know where we are on this one. And then the surprises have just been terrible the whole time. They just, lose more money than they thought. And that's been happening a lot. Like a lot. So there's some negativity out there overall, even though this is Zacks rank number 2. Now, before I go into the bar chart and check out our options chain, let's see what has happened over the last several quarters of reporting for Palo Alto Networks. Last quarter was a memorable one. That huge dive to the downside. Quarter before was a big move down. Big move down in July. Well, solid move down in July and a big move down in April. So since April 2016 quarter end, just been negative, a lot of negative. And we know it's not because of the EPS, because they always miss on EPS. It's all about this revenue number. So where's our revenue surprise? So here in 2016, even in April and July, stock went down, and they had a surprise on the revenue side. So that wasn't enough to make up for the terrible miss on the EPS side. And last quarter's 20-cent miss really just sent things falling apart. So there have been some big moves, and if we go a little further back, a few more double-digit moves. They had a streak of winning, right? And then some big downside moves and all sorts of stuff. So all over the place. And when was that last earnings beat? Let's see if I can find it. Is this it? Yeah, here it is. April 2012, coming in at break even versus consensus calling for a 1 cent loss. Since then, the loss has widened. And here we are. So that's the story on Palo Alto. All right, now let's take a look at the options chain. So we're going to look at the 115s, or 116 now. 116. It's almost, stock's almost at 116. So this is what we'll use. I'm just in the front week. So this is Friday's expiration. Let's go ahead and get our calculator situated. All right, so that, oh, come on, bar chart with the refresh. Just trying to throw me off. Bar chart refresh. All right. Here we go, the 116. Okay, I used to be able to just do simple things like draw circles around strike prices, and now I'm losing my swag. Back to the calculator. At the money calls trading 470 by 530. We'll call that $5 all day. On the put side, 530 by 560. We'll call that 545. So you're talking 1045. They're expecting a $10 move here. Divided by the 116 strike price, that's about a 9% move. And as we've seen several moves beyond that. a few below that, but when this thing moves, it flat out moves. Okay. So remember, our kind of Zacks EPS based analysis on this is really not helping us, I don't think. So we really got to get technical on it, I think, to find some space. So the market's basically pricing in $10. So that could even go below the bottom end of this range, what they're pricing in. New lows to the downside. And then $10 upside pretty much puts you into these December lows, right? So that's what they're kind of pricing in, okay? Now look at the moves. Huge gap down, which gets filled. This gap hasn't even been touched. Let's go out just a couple weeks. We'll just look at the June expiration on these. Instead of the side-by-side, let's go stacked. And let's just price out some options here. And keep an eye on good old open interest. I mean, I think it was pretty obvious that 115, 120, 125, 110, these key sort of psychological levels would be where you'd see a lot of the open interest on the call side. So let's go ahead and just price one of these, right? Let's just look at, well, the 115, I guess, is in the money now. Where are we at? Now 155, 115.78 rather. They're starting to come down a little bit. Let's just look at this. Just while I'm doing my initial pricing here, remember our good old halvesy move we like to do sometimes if the market's pricing in $10? What if it moves 5? Let's just look at what this math looks like. So the at-the-money call is going to cost $6.20 for the 115 call to go long. If you simultaneously short the 120 call, you're going to get back $4.05. This is in the June 16th expiration. So in this case, the amount of money that you can make is $5 minus the 215, or $2.85 on your 215. You can make 132% on this move from 115 to 120 on shares of Palo Alto. Okay. So 132% on that move. And as always, I like to, just for giggles, what does the bigger move look like price-wise? In that case, it's 620 minus the 245. So it's 375. The amount of money you'd make here would be 625. Divided by 375 you have at risk. Talking 160%. So again, when you put it in perspective, you get like 132% that you can gain from a move from 115 to 120. And then adding this extra risk, you get another, what, 34%? Okay. And the other thing about this is, though, I understand it's, what are you also gaining is with this? Well, you're not gaining really, you're actually giving up, because your break even now becomes lower because you're spending more for this option, right? So it ends up in a lot of cases not being worth it to go all the way out to this further strike price, right? If you are in fact bullish here on Palo Alto. So here's a bull credit for you. Bull, what do we call these? Bull debit. Long June, and June is 16th, right? This is going to be, today's June 2nd, yeah. Long June 16th, 115, 120 call spread for a, I already forgot the price, 215, is that what it was? 620 minus 405, what did I say? 215 for 215 net credit, okay? So there's that. Oh, debit. Sorry. I said it right. I typed it wrong. Okay. So there's that. So who's going to do that? Anybody that just thinks that, this has been a little bit oversold, expecting EPS to sort of come in line, and they go and they chase some of the shorts here. If they chase the shorts above 120, I think it definitely starts to get into this gap, and it could run for a while. But there's a lot of negativity right now on this bad boy. So on the bearish side of things, here we can use the 116, get in the money a little bit. Then again, this is a scenario where you got the 110s of the world out there. The 115s, I'm pretty sure the 105 has a lot of open interest there too. And we were saying 110 easily, I think, based on sort of the negativity surrounding the stock, easily. Okay, so going along the 116 put, that's 590. You're going to have to pay for that. Simultaneously shorting the 110 put, you're going to get back 330. So your net outlay is going to be 260. You can make 340 on that 260 or 130%. All you need is Palo Alto to get back to 110 at expiration. So again, the bear debit here is long the June 16th 116-110 put spread for a 260 net debit. So that's what I'm looking at here. And yet you can stretch this out, but it's almost like, for me, if you really want to stretch this out and you're really confident that this is going to move, keeping your sort of the anchor or the long side of your put here at the money is going to limit what your return is going to be. I mean, it's going to get a little higher the further out you go, but it's not going to be all that attractive. If you really want to get aggressive, the thing to do is to buy it out of the money. But you have a very high likelihood of losing your shirt on that one. But that's why the payoff is so nice, right? So, just other ways. Plenty of ways to skin a cat, my friends. I'll give you an example of that. If you're very confident, very aggressive bullish, or aggressively bearish, you scooted out of the money a little bit. Let's say you went to this 112. I know it's crazy, right? But I just want to show you guys something for an example. If you're long the 112, 110, $4 is what you're gonna have to pay for the 112 put. Simultaneously shorting the 110, you're gonna get back 330. So this is only 70 cents. Now the difference in the strike price is $2. Minus that 70 cents is 130. You can make on your 70 or 185%. So you can make a lot more money here, but your break even is going to be way further out too. Okay, but if you really think something's got to take a tumble, that's one way to do it, and be aggressive if you want to. Okay, so there's that. All right, now in terms of credit spreads on this, based on how much it's moved, I mean, I would really be hesitant to put on a credit spread on Palo Alto right now. But if you really want to do it, you'd have to take a put spread that was way underneath here. So put spreads would have to be, I would say, 105 and lower. And then the call spread, 125 and higher, of course, because that's where the options market was pricing in. But you might even need to inch down further than that. So I'm going to change from the at the money to showing all, just to see this. And we're going to stay in the same expiration of the June 16th. And if you look at these out of the money call spreads, up at 125, you still got 245 out there. Difference of 20 there. Still a difference of 20 here. 20's all the way out here. This actually might be the way to go. If you can get filled out here. The 130 call, you're going to get 150. Simultaneously buying the 131 costs you 130. So 20 divided by 80, you can get 25% on selling this out of the money 130, 131 call spread. So that may not be a bad idea. So let's do the bear credit. Short June 16th, 130, 131 call spread for 20 cent net credit. And then here on the flip side, where I was talking about getting out of the money, getting out under that 105. If you notice, these values are a lot lower down here than they were up there. There's a 20 cents there. There's 22 cents there. Further out you go, you can only get about 10 here. And again, guys, this is based on the midpoints of where these are. Just depends on how nice the market makers want to be to you. This might work. Selling the 104 call for, or put rather, for 160, simultaneously buying the 103 for 138. That's 22 cents you can put in your pocket on 78 cents at risk. You make 28% on that. Maybe putting the two of those bad boys together in a condor might be a way to make that pay off a little better for you. So here we go. Bull credit short June 16th. 104, 103 put spread for 22 cent net credit. Okay. All right. What do we have here? Mr. Newman giving us some. What are we doing? Sell the June 105 put. Buy the June 113 put. June 105. Well, where are we at here? Let's just keep this in mind. The June 16, 113. 445. How much are you getting back on the front? Wow, 385? Or no, that's one. Oops, sorry, 105, 105. 90, 130. So you get 130 back. So you got what, 3 and change at risk there. If you think this thing's going to unwind, I don't think that's a bad idea either. There are definitely ways to sell premium into this sort of initial market reaction. And then, but here's the problem though, Dave. What happens? You sell the 105s. And then you've got yours. It's a net debit still for you, right? And then if you get, what if the thing goes to totally just dumps? Then that's your risk, right? Instead it totally dumps, and then you got to deal with the consequences there, right? Which isn't bad. That's still, you should still be able to make money on that though, because your June put's going to be worth a ton of money in that case. So you'll still make money. It'll just get called away from you, or however they call exercised, right? And then you'll have that situation. But you'll still make a bunch of money. And then if it skyrockets, though, then then you're in trouble, obviously. But that is a good way to limit your risk. And I guess compared to the put spread in the same month, it's a little bit different. So there you go. Okay. I got my credits A, credit B, debit A, debit B. Okay, good. All right, so where do I stand on this thing? We're going back to the chart. There is a part of me that's saying, we should probably just squeeze this thing and put an iron condor on, and just forget about it. Newman, yes, it's better than a double. In that case, so let's say this 103. I'm going to go back to, we're going to talk about the chat a little bit here, guys. So we're asking about a 105, 113 put spread, basically. Selling the June 105 and buying, or selling the June 2nd 105, buying the 113 June 16th. So let's say that Palo Alto gets down under 105, right? So what's going to happen is they're going to exercise that 105 because it'll be in the money. But the good news is you'll be able to sell your 113 put for at least $8 because that's just going to be the intrinsic value plus the 2 weeks of time value of whatever that you have on, right? Whereas that June option is going to have absolutely, well, it'll have no time value, right? And it'll just be the intrinsic value. So you're going to get a little bit of, extra perhaps, right? So when you see that scenario, I say you close them out simultaneously right near the end of the day, okay? Because some brokers will be really nice about it and some brokers will be terrible about it, and they'll automatically exercise it for you and then try to get the shares and then put you in, and it's just a nightmare. So if you don't have a bunch of money in your trading account, you don't want to get into a scenario where you have some crazy margin call, I always suggest just close it out right before it's gonna expire, or if it's gonna expire in the money on that Friday. Okay. So yes, you still have, and we were saying it was gonna cost, off the top of my head, let's call it was $445. And then you're going to get back 105 or something for that selling that front month. So $340. Now the difference in the strike prices is still going to be your max, which is the 800 minus the 340. So you can make 460 on the 340 or 135%, right? Which is very similar to what you would see just doing an all out. I mean, you actually see better numbers just doing the put spread in the same month. So you're going to have more money on that 105. So unless you just really think it's going to unwind following the report, there's going to be post-earnings drift where they're going to keep pounding the thing down. But if you look at Palo Alto, sometimes that has been the case where the day was just the beginning and it got beat up some more, right? But they certainly do have gaps that take place also. So, all right, guys. I wonder if you can hear the guy yelling in the hallway right now. It's a wonderful, wonderful place to be right now. Anyway, so I will, I guess my official play that I'm going to say here is going to be the bearish put spread. That's the debit, okay? So I think that this thing will unwind. I think it comes down here to 107s. So I think that's going to pay off because it just looks so weak into this thing, and it's just kind of gone sideways. I don't know that this is going to hold to sort of these lows. And it sucks because it is, in tech, and tech has done pretty well here. But, there have been some nasty, you got nice expectations and then a drop. That's happened on several quarters in a row, and I don't think this is the quarter where this bad boy is going to end up turning around or just going to the upside. Lottos on this, I think, are to the downside. So if you look at the 6-2, if it breaks down, it could get ugly. And what was that level we were talking about? 107s. 107, where's here? Yeah, 107, pretty much. So let's look at this. Is there a 107 put? Get out there. So it's somewhere down. It's somewhere out here. If this thing really unwinds, that it collapses. It gets ugly. So I think you can even do. You could do probably a. Maybe even a 105, 100 put spread. That's a lot. That would pay 105, 100 is going to cost you 83 cents, right? Let's see this. 130 minus 53, 77 cents. With the potential to make 500. So you can almost 6 times your money on that. So I think that's the lotto. I'll say lotto is 105, 100 put spread, 77 cent net debit. All right? Or just the 105 put outright. All right, guys. That's all I got for you here today. Oh, man. It was rough coming back to work after this long weekend, man, let me tell you. Whew. So that's my game plan here on Palo Alto Networks. Remember, tomorrow we've got another action-packed agenda. That's going to be Lululemon. I'm excited for that. I like the Lulu. I like talking about them. And then remember, Friday morning, that's going to be good with our live Q&A the morning after, so that should be good. And then we got another one on Thursday too, so action-packed agenda. Thank you all for hanging out with me here today on Zacks Live Trader, and I will see you all very soon. Have a good one.